Alicia Levine says don't throw the semis out with the bathwater, but you know what? Sprinkle in some financial and healthcare names to the portfolio. Hi, Alicia.
Hi, Liz. Great to be on. And you're singing our song this afternoon. So look, we just published our 2026 outlook. We think that the S&P is going to rise about 10 to 12% next year on the base of earnings that are up 13 to 14% next year.
Okay, wait, the S&P's at 6860, so your outlook would bring it to?
Our high rate on the range is 7,600 right now. We tend to do a range because typically it's on the multiple side. We do pretty well on the earnings estimate. So we put a 21 times multiple on the market. That'll get you to a 7,600. We do see earnings estimates broadening out. And as a result, this year we had a great time with tech. We see healthcare, we see financials and industrials, and you have to, of course, keep tech in your portfolio as well. So we see earnings broadening out this year.
Tech is very, very interesting here, especially considering that it is also a political lever in a way between the U.S. and China. We had just heard from Jensen Huang. Grady Trimble talked to him about these exports, and who knows what's going to happen, but still there are curbs on exports of chips at the moment from the U.S. to China. But that doesn't seem to be stopping the sector.
It's not stopping the sector because many of these companies are actually trading at less than their growth rate. So, so in some of these companies, they're growing twice what their multiple is because there are export controls specifically to China. I think we have to assume that stays on just as a base case scenario because you always want to model the most conservative case for where this is going. But the interesting thing here, of course, there is room to raise estimates if that changes as well. But you really want to take both sides of the risk spectrum into account when you do an outlook for the next year.
Oh, we heard from Macy's and they said, you know what? Okay, a choiceful consumer doesn't mean a consumer that is simply shutting their wallet. How do you view the sort of consumer picture here? They are the ones that hold up this economy.
Look, consumption is 70% of U.S. GDP. I think what's been astounding with all the talk of the K-shaped economy, actually, if you look at earnings that came out in the third quarter, many of the discretionary companies did much better than expected. And we're seeing with Macy's today as well. So it's kind of confounding this doom and gloom, but it's a real issue. And that's why the Fed needs to cut. And you saw from the jobs numbers earlier this morning that it's driving the probability of a Fed cut in December to close to 100% because it is that lower end consumer. It is the households that do not have financial assets that really need the rate cut because they borrow to spend. And if borrowing is cheaper, we would expect consumption to do better. So we like discretionary for next year as well because we see rates lower and the one big beautiful bill, consumer stimulus coming out at $160 billion by tax day in April.
Well, that is going to be a huge bump as well. And listen, Alicia just made a really good point about those who borrow, and that goes for the Russell 2000. Small and mid caps, they're the ones who need to borrow to grow. And boy, is the Russell jumping right now. Russell is up 43 points or 1.75%. So great to have you. Happy holidays.
Great.